third down day in a row, and the Dow is still hanging on to a weekly gain along with the Russell 2000. So what should investors do now? Rebecca Patterson is former chief investment strategist at Bridgewater. Rebecca, welcome. It's great to see you.
You too.
Okay, what do you say? Someone's there, they've got a glass of rosé, and they say to you, Rebecca, what do I do with my stocks now? Should I be chasing the small caps? Do I worry about the election? Do I stick with my NVIDIA? What are you telling people?
Well, let's start with NVIDIA and tech. I'm neutral right now. I think that there's obviously a lot of optimism priced in. It's a very crowded trade. At the same time, there's some very important structural benefits and comparative advantages of these companies, particularly the profitability, the free cash flow that allows them to constantly reinvest in their own innovation. So I wouldn't be running away from it. And maybe you even are looking at these pullbacks as an opportunity to add if you're not in there yet, which is hard to believe anyone out there might not be. But then beyond that, the small cap rotation, it was a violent move that we saw earlier this week, 11% in basically 4 days. And I've been skeptical about small caps really for the last few years, largely on the back of my own view that the Fed would keep rates higher for longer. And I think part of what saw this rally happen was some better inflation that allowed the market to price in a September ease and further easing ahead. So what do you do from here, to your question? I think it really is going to depend on two things. The Fed may feel inclined to cut September. We'll see if we get the data for that. The question I have, though, is next year. The market's still discounting about 115 basis points of easing next year. And the small caps are discounting that as well. So do you get that much easing? These companies need lower rates. They have relatively higher debt and more floating rate debt. The second issue is growth. Growth has held up relatively strong in recent months, moderating a little bit, but generally resilient. And even today, the New York Fed updated its Q3 GDP estimate to 2.7%. That's great. But there's other indicators saying we need to be cautious. If you look at jobless claims, they're noisy, but they're ticking higher. If you look at the service sector, the latest business sentiment survey, the ISM, had both employment and new orders contracting. So there's reason to still be cautious on that growth outlook. And to me, without having the all clear on those two things, I'd be nervous chasing or adding a lot more exposure broadly to small cap. It doesn't mean there aren't selective opportunities for active managers, but I certainly wouldn't be adding the small cap index in any size yet to my portfolio.
Rebecca, one of the interesting topics of conversation, or even debates, if you want to characterize it as that I've had over multiple cocktail conversations or conversations with investor groups or investors, is the idea of how big a pullback could be. And one of the topics that was brought up was just how much leverage there is in the system, and that it seems like in the tighter rate environment that we're in, the amount of leverage that we have in the system chasing assets like stocks is not nearly as bad as it has been in other periods that have seen bigger market declines. I wonder if you can take us through whether or not you feel as though we can have a massive market decline if there isn't as much relative leverage as, say, back in the dot-com era or even during the 2008-2009 financial crisis.
Yeah, no, it's a great question. I love how you both are just kind of pulling in cocktail hour in your comments there, too, on a
It's
Friday
5 o'clock
afternoon.
somewhere, Rebecca.
Wishful thinking.
It's been a long week and a long day. Anyway, so with leverage, I think this is a really important point. Obviously, in the run-up to 2008, where we had that huge sell-off, the GFC, you had leverage among consumers, leverage among businesses, leverage in the financial sector. Today, the leverage is largely in governments. When we think about debt to GDP, that's where the excesses are. That's where the vulnerability is. And I think that plays out very differently in markets. But if I am looking for where is there some risk, one thing that I am very focused on right now is the retail investor. And you all have talked about this on air quite a lot, which I'm thrilled you are, because it's so important. We're back now to levels where the retail investor's role in the broader market is the biggest it's been since pre-GFC, pre-dot-com bubble. And that doesn't mean we're going to see the same result, but it does mean it's something we have to pay close attention to. They now have low or no fees. They have trading platforms that feel more like video games, and they have a lot more instruments they can use, whether it's, to your point, Dom, triple leveraged ETFs or zero-day options that allow them to trade on margin. And so to a degree, there's leverage in that part of the market right now. And I do think that is part of the reason we're seeing the volatility we're seeing on an intraday basis in single names. You know, the reaction we had earlier this week to former President Trump's Taiwan comment, I think that's a great example. He makes comments like that all the time. We know that. Doesn't mean they're going to turn into policy. And yet the market reaction was so outsized, in my opinion. Maybe some of that was positioning ahead of the comment. But again, to me, it also feels like it could be partially driven by this retail investor who's saying, cool, I've got a zero-day option. I'm going to make a quick trade and see if I can make some money off this. And I think that is a part of the market that's become much more meaningful that we have to watch carefully.